In your hand right now, you might be holding a gold wedding ring. Maybe it weighs 5 grams. At today's spot price of $2,685 per troy ounce, that ring contains $432 worth of gold. But here's what's strange. If you tried to sell that ring back to a dealer right now, actual physical gold that you own, they'd offer you $378. That's a 12.5% discount to spot. But if you tried to buy a new 5-gram ring of the same purity, you'd pay $527, not $432, $527. That's a 22% premium over the spot price your screen is showing you. The price you see and the price being paid diverged, not by 2%, not by 5%, by 22% in physical retail markets, and by $95 per ounce in wholesale dealer markets as of January 2nd, 2026. Now multiply that disconnect by the 2,645 tons of physical gold that cleared through London vaults in December 2025, the highest monthly clearance volume since March 2022. And suddenly you're staring at a pricing mechanism that stopped reflecting reality. This is not about gold going up. This is about paper gold and physical gold becoming two different assets. Here's what they're not telling you. On December 27, 2025, at 6:43 p.m. London time, the London Bullion Market Association issued Technical Notice LBMA/2025/TN-441 to its clearing members. The notice was 3 pages long. It updated acceptable delivery timeframes for allocated gold transfers between vault operators. The previous standard was T+2, 2 business days from trade date to physical delivery. The new standard is T+5, with an option to extend to T+10 during periods of elevated operational demand. Translation: if you buy physical gold in London, supposedly the world's largest and most liquid physical gold market, the dealer now has up to 10 business days to actually deliver your metal. Not 2 days, 10 days. And they can invoke this extension anytime they claim operational demand exists without independent verification. This is not routine settlement updating. This is a countdown timer being installed because the system is already failing delivery obligations. The mechanism works like this. When you see $2,685 on your screen, that price comes from COMEX futures contracts trading in New York. Those are paper contracts. Each contract represents 100 troy ounces of gold. But most contracts never result in physical delivery. Traders close positions before expiration. They take profit or loss in dollars and move on. The price discovery happens in paper. Physical gold, the metal itself, trades at whatever premium the market will bear above that paper price. In normal times, that premium is 1 to 3% to cover fabrication, transport, storage, and dealer margins. But December 2025 wasn't normal times. COMEX data from December 31st shows 23.7 million ounces in total inventory. Of that, only 8.4 million ounces sit in registered vaults, metal that's available for delivery against futures contracts. The rest is eligible inventory, privately owned metal stored at COMEX facilities but not available for contract settlement. Now look at open interest. As of January 2nd, 2026, COMEX Gold Futures open interest sits at 487,000 contracts. That represents 48.7 million ounces of gold. Paper claims on 48.7 million ounces, backed by 8.4 million ounces of registered physical metal. That's a ratio of 5.8 paper claims for every physical ounce actually available for delivery. At 8:17 a.m. Eastern on December 18th, 2025, JP Morgan Chase increased initial margin requirements for gold futures by 18%. That means if you were trading gold futures with $10,000 in posted margin, you suddenly needed $11,800, or your position would be liquidated. No warning, no grace period, just a technical notice sent to account holders at 8:17 a.m. demanding additional funds by market close. The official story is risk management in volatile markets. The data shows something else: forced position liquidation to prevent delivery demands from overwhelming available physical supply. This is where the lie becomes unsustainable. Paper gold is a promise. It's a contract that says you have a claim on gold. Physical gold is atoms. It's metal that has mass, occupies space, conducts electricity, and doesn't tarnish. For decades, the paper market functioned because most participants never asked for delivery. They traded the promise. They captured price movements in dollars. And the system maintained enough physical inventory to satisfy the small percentage who actually wanted metal. But something fundamental broke in Q4 2025. The premium data tells the story. In April 2025, physical gold bullion coins traded at a $42 premium over spot. 1 ounce American Gold Eagles cost spot plus $42. By September, that premium rose to $67. By December 15th, it hit $95. That's a 126% increase in premium in 8 months, while spot price rose only 12% during the same period. Physical gold and paper gold are diverging. The premium is not fabrication cost inflation. It's not transportation delays. It's a shortage of physical metal at the paper price. Between October and December 2025, the U.S. Mint sold 393,000 1-ounce Gold Eagle coins, the highest quarterly sales since Q4 2016. The Royal Canadian Mint sold 287,000 gold maple leaf coins in the same period, the second highest quarter on record. The Perth Mint in Australia reported a 7-week delay for new gold bullion orders as of December 20th. Not a 7-day delay, a 7-week delay. When refineries can't keep up with retail demand, when major mints report record sales, when delivery delays extend from days to weeks, the market is sending a signal. Physical metal at the paper price doesn't exist in sufficient quantity. The London Bullion Market Association reported 2,645 tons cleared through London vaults in December 2025. To put that in context, annual global gold mine production is approximately 3,000 tons. London cleared 88% of annual global mine production in a single month. That metal is moving, it's leaving vaults, it's being taken into possession, and it's not being replaced at the same rate it's being withdrawn. When institutions do this, when they extend settlement terms from T+2 to T+10, when they hike margins by 18% overnight, when they quietly revise acceptable delivery timeframes, they're not managing normal market conditions. They're containing a delivery crisis. On January 3, 2026, at 3:47 a.m. Eastern, COMEX announced a temporary reduction in daily position limits for gold futures from 6,000 contracts to 4,200 contracts per trader. That's a 30% reduction in maximum position size, effective immediately. If you held 5,500 contracts on January 3rd, you had 72 hours to liquidate 1,300 contracts or face exchange-mandated liquidation and potential penalties. This has only happened 4 times in COMEX history: September 1999 during the Washington Agreement gold spike, March 2008 as Bear Stearns collapsed, August 2011 after gold briefly touched $1,923, and April 2020 during COVID delivery failures. In each case, what followed was violent price volatility as forced liquidation met delivery pressure. Less than 96 hours remain before the February futures contract enters first notice day, the deadline when contract holders must declare delivery intentions. COMEX data shows 41,200 February contracts still open as of January 3rd. That represents 4.12 million ounces of potential delivery demand. Registered inventory sits at 8.4 million ounces. The mathematics are simple. If half those contracts demand delivery, that's 2.06 million ounces leaving registered inventory. If registered inventory drops below 6 million ounces, the ratio of paper claims to physical availability exceeds 8 to 1. And at 8 to 1 leverage, the system becomes mechanically unstable. While COMEX reduces position limits and extends settlement timeframes, the People's Bank of China reported adding 160,000 troy ounces to official gold reserves in November 2025, the 17th consecutive month of additions. That's 5 tons per month entering Chinese central bank vaults. Not leaving, entering. At 9:23 a.m. Beijing time on December 21, 2025, the Shanghai Gold Exchange reported physical gold trading at a $37 premium to London spot prices. That's the highest Shanghai premium since February 2016. The premium exists because Chinese buyers are willing to pay $37 per ounce above international prices to secure physical delivery in China, rather than trust Western vault storage or paper claims. Russia added 28 tons to central bank reserves in Q4 2025. India imported 312 tons in December alone, the highest monthly import total in 18 years. These are not speculators chasing momentum. These are sovereign nations securing physical metal while Western paper markets offer it at suppressed prices. While JP Morgan hikes margins to force paper position liquidation, China takes possession of 5 tons monthly. While COMEX extends settlement terms to manage delivery pressure, Russia adds 28 tons to reserves. One side creates administrative controls. The other side takes delivery. This is not about price. This is about who controls settlement when paper promises can't be fulfilled. The dollar system requires gold price suppression, not because central banks fear gold itself, but because gold price is the inverse of dollar confidence. When gold rises, markets signal dollar skepticism. When gold rises persistently, that skepticism becomes structural doubt. And structural doubt forces central banks to choose between defending the currency through rate hikes, which kills growth and increases debt service costs, or accommodating inflation through rate cuts, which accelerates dollar debasement. Gold price suppression through paper market manipulation solves this dilemma. Keep futures prices stable through margin hikes, position limits, and settlement timeframe extensions. Most market participants never take delivery. They trade the paper price. And as long as paper price remains controlled, the illusion of dollar stability persists. But suppression only works if physical delivery remains optional. The moment delivery becomes mandatory, when central banks demand repatriation, when refineries can't source feedstock, when retail buyers exhaust dealer inventory, the divergence between paper price and physical price becomes visible. And visibility destroys the suppression mechanism. The Bank for International Settlements reported in its December 2025 quarterly review that central banks globally added 337 tons to official reserves in Q3 2025, the highest quarterly addition since Q2 2022. The World Gold Council estimates full-year 2025 central bank purchases will exceed 1,100 tons. This is the fourth consecutive year of 1,000-plus ton central bank accumulation. These institutions are not speculating on price appreciation. They're diversifying away from dollar-denominated reserves because they watched the U.S. freeze $300 billion in Russian central bank assets in March 2022 and understood that dollars held in Western banks are not assets. They're liabilities that can be seized without legal recourse. Gold held in your own vault cannot be frozen. It cannot be sanctioned. It requires physical force to confiscate. And that makes it strategically valuable when trust in Western financial infrastructure declines. While the Federal Reserve maintains its balance sheet at $7.2 trillion, having created $4.7 trillion since March 2020, China takes possession of physical gold. While the European Central Bank holds 4.8 trillion euros in assets backed primarily by sovereign debt from insolvent peripheral nations, Russia accumulates metal. Atoms versus digits, promises versus possession. This is what a system looks like when it runs out of credible policy options. If gold price rises to reflect the physical premium, $2,780 instead of $2,685, every futures short position on COMEX faces margin calls. At 5.8 to 1 leverage between paper claims and physical inventory, a $95 move triggers $550 in margin requirements per paper ounce. Multiply that by 48.7 million ounces in open interest. That's $26.8 billion in margin calls generated by a $95 price increase. But if they keep suppressing paper price through margin hikes and position limits, physical inventory drains faster. Retail buyers pay the premium, central banks take delivery, refineries struggle to source feedstock, and the divergence between paper and physical widens. Every intervention designed to suppress paper price accelerates physical depletion. Every margin hike that forces long liquidation creates buying opportunities for those seeking physical delivery. The trap closes with mathematical precision. There is no policy response that doesn't worsen the underlying imbalance. This is a pressure valve that's been welded shut. Suppress paper price and physical drains. Allow paper price to rise and shorts face catastrophic losses. The system cannot suppress and cannot release. Every turn tightens the mechanism. The COMEX vaults hold 8.4 million ounces in registered inventory as of January 3, 2026. Global gold demand in 2024 was 4,448 tons, approximately 143 million ounces. The registered COMEX inventory represents 5.9% of annual global demand. If physical buying accelerates by just 10%, if demand rises from 143 million ounces to 157 million ounces annually, that incremental 14 million ounces exceeds total COMEX registered inventory by 167%. The mathematics don't care about administrative controls. They care about ratios. When paper claims exceed physical availability by 5.8 to 1 and physical demand increases, either price rises to ration demand or delivery fails. There is no third option. Right now, central banks are accumulating at the fastest pace since 1971. Sovereign wealth funds are taking delivery rather than holding unallocated claims. Large family offices are paying $95 premiums to secure physical metal rather than trusting paper ETFs at spot prices. These institutions understand that in a settlement crisis, possession is the only claim that matters. Paper promises are only valuable if the counterparty can deliver. And when delivery time frames extend from 2 days to 10 days, when premiums rise from $42 to $95, when registered inventory can't satisfy even half of potential February contract delivery demands, the counterparty's ability to deliver becomes questionable. The question isn't whether to panic, it's whether to understand mechanism. Most will react to the spot price on their screen. They'll see $2,685 and think that's what gold costs. A few will understand that spot price is the paper price, the price at which promises trade. The physical price is spot plus $95. And that $95 premium is not a retail markup. It's the market signaling that metal at the paper price doesn't exist in sufficient quantity. Markets can remain irrational longer than you can remain solvent. But markets cannot remain irrational longer than physics permits. Paper can be printed infinitely. Metal cannot. Look at the gold ring in your hand, the one that weighs 5 grams. That ring is not a financial asset. It's not a contract or a claim or a promise. It's atoms arranged in a specific crystal structure that doesn't corrode, conducts electricity, and has been valued for 5,000 years across every human civilization. The divergence between the paper price you see on your screen and the physical price you pay at a dealer is not a market inefficiency waiting to normalize. It's the market slowly, then suddenly, remembering that paper is a claim on reality. But reality itself doesn't negotiate with administrative notices and margin requirements. When settlement stress exceeds system capacity, the promises break before the metal does. And what seems like a functioning 2-day settlement market reveals itself as a 10-day settlement market, reveals itself as a market where settlement is no longer guaranteed at all. This is not prediction. This is observation of mechanisms already in motion. The premiums are rising. The delivery timeframes are extending. The registered inventory is declining relative to open interest. And the only question remaining is who understands what's happening before the divergence becomes terminal. The divergence between paper and physical is not a market anomaly. It's reality, reminding us that gravity still works, even in finance.